In this week's video, we'll cover avoiding common missteps with rate hikes, charts, and markets. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. These are the main topics we'll be covering. If you'd like to read this, you can pause the video in the lower left-hand corner of your video player. Many of the concepts that we use in technical analysis and with the market model can also help us with interest rates in a statement like this. We should sell stocks because the Fed is raising rates in September. That's a forecast, and that's an opinion. So keep in mind when you see talking heads or reporters or discussions about interest rates on CNBC or a report written by an analyst. For the most part, that's a personal opinion, and even if it's something like the opinion from Goldman Sachs, that's still a small group of people relative to the entire market. It's a forecast. The people making the forecast, like all human beings, would like to be right, and therefore their ego comes into play. There's a better way to track the probability of interest rates going up in terms of the Fed hiking them with liftoff. Fed fund futures, 30-day Fed fund futures, is not an opinion, it's price. There's people investing. These are interest rate contracts, people putting their money where their mouth is. So many opinions are saying it's a done deal. They're going to raise rates in September. What are the markets saying in terms of investments and bets? As of the close on Friday, the market, in terms of 30-day Fed fund futures, the implied probability of a rate hike in September is currently 0. October, 28% chance, which basically says there's a 72% chance they won't hike, and we get out to December, it's basically a coin flip. These probabilities can change quickly, so we'll use them the same way that we use any other chart or price. We'll keep an unbiased, flexible, and open mind, but right now, the facts and price are saying we really shouldn't be too worried about liftoff in September, given what we know today. And regardless of how we parse the Fed statement and our personal opinion on the recent Fed statement, the market, in terms of Fed fund futures, the probabilities of a rate hike in September dropped after Wednesday's statement. The bad news for stock market bulls and stock market bears is that as of the close on Friday, July 31st, the daily chart of the S&P 500 remains in the same range. The good news for the bulls, has it been an even battle? No. The daily closes above the mid-range have occurred 67% of the time, and daily closes on the lower end of the range have only occurred 33% of the time. Now let's take a look at some of the moving averages tracked by the CCM market model. These are weekly charts. Regular viewers know that this is a full-bore bearish look with price below both moving averages, blue below red, and the slopes of both are down. It looks nothing really like a full-bore bullish look, which is price above both moving averages, blue above red, and the slopes of both are up. How does the exact same chart look today? The answer is it leans bullish, but it's still a confused mess. We are holding above these weekly support levels that we've noted in the past, and now 2076 also becomes important. Let's zoom in here to get a better understanding of the full-bore bullish but extremely tentative look of the weekly chart of the S&P 500 as of the close on Friday, July 31st. This is still a could go either way chart, so we have to be flexible. It is leaning in the short term in the bulls' favor. We'll see what next week brings. Same concepts here. Now we're looking at weekly charts. Another set of weekly charts in MAs tracked by the CCM market model. A full bore bearish look is when blue, the fastest moving averages on the bottom, prices below all the moving averages, and the slopes of all of them are down. Full bore bullish look, blue, the fastest moving averages on top, the slope of all the moving averages, they're all pointing up, and prices above all the moving averages. How does the exact same chart look today? The present day chart as of the close on Friday, July 31st is similar to the previous chart that we looked at. It's really checking all of the bullish boxes, at least using these moving averages, but it's extremely tentative. This could flip over the other way relatively quickly, and it also should be noted there are numerous moving averages on longer time frames that are showing some wear. So we can't emphasize enough the need for continued flexibility should this chart begin to morph into something more like this. Right now it's allowing us to be patient with our longs, but we can't be patient much longer relative to the math, and we really need the math to improve over the next 5 to 10 trading sessions. Now we're shifting gears to market breadth, and we will use market breadth to illustrate numerous concepts that can be used on any chart. The first one would be human bias and assumptions. We want to avoid that. Let's use a hypothetical. Let's say I've been bearish for the past 6 weeks or so, and I see this chart here that market breadth is getting weaker. I could make an assumption that weak breadth means the bull market is coming to an end. Regular viewers know that we've already shown that market breadth is important, but it's not a showstopper in isolation. The irrelevant investor, and here's his Twitter handle, has completed what I believe is the most comprehensive and best analysis on this topic. What this shows is between 1937 and 2007, when the NYSE AD topped, how long did it take in these instances for the market to top? And the answer is, on average, it took 287 calendar days, and the stock market gained 14% after the AD line peaked, which means that assumption is inaccurate. It's not accurate to say that weakening market breadth is a showstopper. And maybe more importantly, it's also not accurate to assume that market breadth has peaked in any period. If we make the assumption that it's already peaked, then we could also make the assumption that the stock market should probably peak within the next 280 to 290 some odd days. That's not an accurate assumption. Why? 2010, I'm sure you can find articles stating that market breadth is getting weak and the bull market is about to end. This is extrapolation. We can't assume that this chart will continue to be weak. Why? Because there's no market law that says a chart that looks like this can improve and turn into this. This is the exact same chart. It speaks to the need for flexibility and to understand that a weak-looking chart can, and they often do, improve. Same concept in 2011. The AD line broke a trend line, made a lower high, and then went on to make a lower low. It's easy to say that this will continue to weaken, but we always have to understand that a chart that looks like this can morph into something like this. 2012, the advanced decline line, it looks terrible. This chart here eventually morphed into this chart here. 2013, let's assume we had made the assumption that the AD line had peaked. Therefore, we could go to that table and we could say, well, it doesn't matter now, but it's only a matter of time before it matters. That's not a safe assumption. We can only go to that table when we know the AD line has peaked. And in this case, that was not a safe assumption because it righted itself and eventually went on to make a higher high. We can't assume in 2015 that we won't go on to make a higher high. We may not, but we can, which speaks to flexibility. The charts and price will guide us. Had we made the assumption in 2014 that the AD line had peaked, we would have missed the rally off the October low. It had not peaked because this chart here morphed into this chart here, and it did go on to make a higher high, reinforcing the need to keep an open mind about the AD line in 2015 and an open mind when we view any chart for that matter. Notice none of the examples that we just went over are in the Irrelevant Investors Excellent table. Why? Because the AD line went on to make a new high. So we don't know whether 2015 will make it into this historical table or not. Moral of the story, an ugly-looking chart or statistic can improve, just as a good-looking chart or favorable statistic can deteriorate, which is why we always need to maintain maximum flexibility. It's possible that market breadth, new highs and new lows, is trying to improve. This is a weekly look of NYSE new highs minus new lows, and that's a nice looking candlestick. It doesn't really tell us anything about what's going to happen next week, but it does tell us that the probability of a turn is probably higher today than it was a week ago with this candlestick. Remember, we've been saying that sentiment can be helpful when it's near extremes. We've got some new extremes. We have not covered these before. The concept of using sentiment at extreme levels is summed up by Mr. Buffett. Be fearful when others are greedy, and greedy when others are fearful. American Association of Individual Investors. Percent bears has not been this high, meaning the reading that we had this week in 2015. Percent bears has not been this high since August of 2013. Here's the present day reading. Here's the reading in August of 2013, courtesy of Bespoke. This is the S&P 500. If we zoom in, what happened when sentiment was similar to what we have today? Did the S&P 500 tank? No, just the opposite. It rose off of this high percent bear low and tacked on 13.7% in a matter of months, telling us to keep an open mind about all outcomes, including better than expected outcomes. This is also new sentiment data. We have not covered this. We covered neutral. Now we're looking at 8-week moving average of the American Association of Individual Investors percent bulls. This is another piece of excellent work from Ryan Dietrich. Ryan writes, the last time we saw bulls this low for an extended period of time was the March 2009 lows in the stock market. The time before that was March of 2003. Remember, we're not cherry picking these periods. Here is the 8-week moving average of percent bulls. It has not been this pessimistic or this low. We have to go back to March of 2009 when the stock market, this is the S&P 500, did extremely well. It went from 666 to 1220. That's this period here. Present day, 2015. The other time where we can find a reading like this is March of 2003. What happened? 2003, the stock market moved from 788 to 1163, telling us to keep an open mind about all outcomes, including better than expected outcomes. Some more great and new stats from Ryan. This is Ryan's Twitter handle on consolidation. 2015, we have the tightest 8-month range since 2005. The market needs to consolidate its gains. What happened next in 2005? Did the market crash? No. After it broke out of the range, it gained almost 7% in a matter of months. As regular viewers and clients know, we don't make decisions based upon any bullish analysis or forecast. Price must confirm any bullish analysis, including the ones that we've just shown, as well as any bearish analysis. As we've noted on Twitter, the charts are still in could go either way mode. We will have to, most likely, mathematically take some defensive action next week if the market cannot continue to climb. As always, we will enter with a flexible, unbiased, and open mind. The charts, the hard data, and the market model will guide us if we're willing to listen. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.